a lot of off-market deals now that we're able to negotiate really good discounts. So if you're able to get something at a very good basis, it's a great time to purchase those assets. Just the cyclical nature of real estate, we will be seeing cap rate compression in the next few years.
All right, welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Param. Param is a radiologist turned into real estate mogul, achieved financial independence by 41, managing over $150 million in assets, founder of GenerationalWealthMD. She aids physicians in wealth building. She also supports education for disabled children in India. Param, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, thank you for having me, Josh. It's an honor. So I think you kind of summed it up, but basically a physician, Southern California, and I was doing what most professionals do, working hard, thinking I was investing right and investing primarily in the stock market till I had a rough career transition about 2019, and I wanted to get to financial freedom faster. So used real estate. I essentially set a 3-year goal for myself, and then within a year, I got into the point where I was financially free. My portfolio was throwing out enough cash flow to kind of sustain my needs and the needs of the family, including discretionary spending. And that's when I decided I wanted to start talking about this. And, I started building a community around this. I help other, physicians and professionals in general kind of grow their real estate portfolios. We help them build their own direct ownership portfolio. That's what Generational Wealth MD is about. And the community is about a lot of education and coaching and helping support people do that. And then we realized that we're 15,000 strong in terms of the community strength. And I realized that 85% of the people don't want to build their own portfolio. They want to invest passively in real estate. They do want to, benefit from the high returns, the tax efficiencies, and, diversify and have lower risk in their portfolios, but they don't necessarily want to go ahead and build their own portfolio. And so we created GW Capital, which is the syndication part where we are sponsors. We bring vetted, curated deals to the community, and people are still able to add real estate, without all of the barriers of direct ownership, but just invest passively in real estate and still be able to get those higher returns, really accelerate that and generate meaningful cash flow, meaningful passive income, while tapping into the tax efficiencies that real estate affords.
Awesome. So we're going to totally rewind here. You had mentioned that you've created financial independence within 1 year of investing in real estate. Is that correct?
For me, yes. I had started in 2014. I started real estate investing in 2014, but I was very, very passive in my portfolio, just bought a rental here and there. Every time I was on maternity leave, I had time on my hands, I'd buy something. So I had about 2 properties. I had a property manager, very hands off. But that was the 1 year was when I really accelerated things. And I had a goal of getting to $10,000 in tax-free cash flow from my portfolio every month. I started off, I was at between 3,000 and 4,000, and I got to that 10,000 mark within a 1 year period. Yes.
Okay. All right. Got it. Now I understand. So it's really, really good timing, or you met the right people at the right time and the right property, because that can happen too. It only takes one property. If you find it right, buy it right, you manage it right, finance it, everything can definitely happen for sure. But it takes education to get there too. So tell us
Absolutely.
about how you went about, because you definitely didn't just fall into it and just started investing. How did you gain the educational piece, the knowledge piece, in order to be confident to go out there and invest?
Yeah, so a lot of great points there, Josh. So some of it has to be, it's either a combination of strategy and timing, right? So how does that actually happen? I think the most important thing was the point where there was a lot of frustration, just from where I was in my career, and realizing that I wanted to get to financial freedom because I had the time, I had the resources. I even had a mentor back in 2010, which was possibly the best time for anyone to be investing in real estate in hindsight. And I didn't really do it there, right? So I think a big part was the motivation and actually sitting down, writing my financial independence numbers, and realizing that with a third of my money in real estate, I was generating about twice as much in cash flow compared to the stock market, right? So that realization, I think when it comes to the education piece, the first thing was really understanding the impact that returns in real estate can have on my portfolio, right? And so I would say when it comes to timing, in hindsight, there was always the right time to invest in real estate, right? Same thing for between 2010 and 2014. But 2020, when I was investing in real estate, was at the peak of the pandemic. That's when I kind of went through that the transition. And it was a time when everyone around me was telling me, I don't know if you remember, any single family home that was about 350K in January of 2020 was about 400,000 in April or May, right? So there was already a huge spike, and people were waiting for home prices to crash, which never happened in hindsight. But so it wasn't necessarily sitting there. It didn't feel like the right time to be investing in real estate, but it was more about strategy and leaning into the numbers, right? So I ran the numbers. If a property seemed like it was cash flow positive, I just started deploying. And what gave me the strength to deploy was realizing that my returns in real estate were significantly higher than the stock market, right? So that was the only way I could get to my goals. Without, I ran these numbers. We actually have a financial independence worksheet that I used. It was going to take me 17 years to get to financial freedom using the stock market. And my plan for real estate at that time was based on passive ownership of rentals and having a property manager, right? So 3 years with real estate. But then the way I was able to take it down to 1 year in real estate was because I started deep diving into tax courses. I realized that there were ways for me to invest in real estate and actually shelter my W-2 income from taxes. And our students are doing this now on a regular basis. So short-term rentals, it's a way where even if you're working full-time in medicine, which I was at that time, I was able to invest in short-term rentals. I tacked on strategies. I did a rehab on short-term rentals, right? So I'm building up equity, increasing my cash flow, and at the same time, I'm recycling my money, because whatever I put into the property, I was able to. So there's a way where you can go in with 10% down for a short-term rental, and if you're materially participating in it and there are criteria you need to meet, you can actually, when tax time comes, pull out everything that you put in the property just because you're able to shelter your hundreds of thousands of dollars of W-2 income from taxes, right? I have students who bought 2 short-term rentals last year, and they didn't have to pay taxes on $800,000 of clinical income that they made in medicine, right? So that's super powerful. That, and then using the BRRRR strategy, which is where you go rehab a property, you force appreciation. So these are all ways where you're not waiting for market prices to go up. And that's where the timing part comes in, right? That's like, are you timing the market? Are you able to, buy a leveraged property and tap into market appreciation? So the beauty of real estate is that it's unlike the stock market. You can go in and rehab a property. You can tap into those tax strategies. You can run something as a short-term rental, a mid-term rental, a residential assisted living, where you're having significantly higher cash flow, and that's in your control. You're not waiting for market appreciation to happen. So kind of tapping into, learning to tap into all of that was what enabled me. And so I was blown away, because when I started, I was like, I'm just going to buy 3 rentals a year for the next 3 years, and then rent them out in the right markets with the right amount of cash flow, and I'm going to hit my numbers. But then when I started deep diving into these strategies, I realized there was a faster way to do it, where you can get up to 200% ROI from your portfolio in 1 year, and actually in 6 months. I actually have a ebook. If anyone wants to go to the website generationalwealthmd.com, I have a free ebook where I put down the actual numbers of the properties I invested in, and show you how I got a 200% ROI in 6 months. And so that's the beauty of real estate, that I think when we're beginning, the traditional retirement model doesn't necessarily talk about it, and you don't have that option, but you can do it with real estate, which is what got me to that point. Well, hopefully there's some clarity in that answer over
Yeah,
there.
we're going to have to digest this here for a second. You're giving away a lot of information, so let's soak it in. So on short-term rentals, and I'm assuming that you're using depreciation to hedge
Yes,
the taxes,
absolutely.
and you can have professional real estate investor status to offset your W-2 income if you qualify, and if you
That's a
check the
harder bar.
boxes.
That's a harder bar to meet, but I do meet that criteria now. But with short-term rentals, the advantage is, even if you and your spouse are both working full time, you're still able to tap into that bonus depreciation and use it to give you that huge boost in terms of tax savings. So you're basically keeping money in your pocket and using it to keep scaling, and you're not waiting to save like another $100,000 to be able to go and grow your portfolio.
Yeah. It's definitely a gift that keeps on giving. If you play the cards right, do it right, and to set up, have the right team,
Yeah.
right law group, tax, everything goes into it. And
So many things
Airbnbs,
that go into it. Absolutely.
yeah, and your depreciation on fixtures is a lot more than the property itself. Let's get to the $150 million in assets. Let's how many units is that, and then how did you get to this point?
Yeah, so that's 200 million in assets under management. At this point, the number keeps shifting, as I'm sure it happens for you too. And that's over 1,000 units across 7 properties at this point. So that's when we started building out GW Capital, which is where we're taking in investors. So that's where I'm a general partner, along with I work with other sponsors who are more boots on the ground, and we're building So that's more stabilized value add multifamily apartment complexes in strong markets across the country. And that's where we help members in our community invest passively in real estate. And so that's bringing those opportunities to the community.
Got it. Okay, so what areas are you underwriting properties to purchase in?
So typically I love the Sun Belt. So we have properties in Phoenix, Arizona, Atlanta. We have about four properties in Atlanta, Georgia, and then Greenville, South Carolina. I believe that's where we are. We're also aggressively underwriting in Dallas, Texas, at this time, which I think is a strong market from a demographic standpoint. So, and then we also have a property in Indiana. So we like to go into landlord-friendly markets, which is true for most sponsors, and markets with strong demographics.
I think Dallas. I think the report just came out that their normalized vacancy right now is like 11% with all of the new inventory coming online.
That's true for both Phoenix, Dallas, Vegas. A lot, those are the markets where there's been a ton of supply, and so yes, they're struggling with absorption. But I feel like that's still a short-term trend, and we are going to see absorption. And the reason there is so much supply in those markets is because there's tons of migration happening on a regular basis, right? And that data that's still happening. It happened during the pandemic, and they are struggling with oversupply. But I think in the long term, those markets still have strong, job and population growth, and so we're still underwriting over there.
It's definitely, you've got to be long term there for sure, because it's been the
Yeah,
long term since, I think, since it started popping 20 years ago. And it'll continue because there's such strong migration that now
there is.
you just have a constant stream of new supply. And
Yeah.
the normalized vacancy is what it's going to be for the near future, too. Um, as long as you underwrite for that. I mean, you can't underwrite for 5% vacancy and to go in cash flow negative throughout the entire duration. It's
Yeah,
just,
you have to be very conservative in what you're underwriting, and it's also again every submarket is going to is going to do differently. Every vintage is going to have a different occupancy, and so yeah, as long as we are aware of what we're getting into and we're underwriting for it. But I think even when we were looking at Phoenix data, the expectation is that rents are going to start rising, and that's going to start normalizing in a few years. But you're right, again, you do have to have a longer term strategy.
what is your all's asset class that you all typically go to purchase?
So we're trying to stick to A minus and B plus assets. So anything that's definitely 1985 or newer is what we're targeting, and it's stabilized value add multifamily at this time. We are looking to add, a few other asset classes maybe in the next few years. We're looking at car washes and ATMs just because, again, everyone in the community doesn't necessarily have the same goals in terms of what they're looking for in terms of depreciation or cash flow. And so some people are more interested in velocity of growth. For other people, cash flow today is more significant. And so we want to make sure we're meeting the needs of all of those, those different subsets. And so we're looking at different asset classes. For now, we've stuck with stabilized value add in A minus and B plus.
I did see a Bitcoin ATM machine in one of the stores here locally. I don't know.
Interesting. I didn't know that.
Yeah. I don't know if it's going to be something of normal, or and I'm not even sure how it works, but it was.
Wow. Yeah. Yeah. Well, ATMs again throw out a lot of cash flow, and then their depreciation doesn't need to be recaptured. So that's something that's attractive for some people. So definitely something we've been looking into.
Is that just the $3 or $4 fee from the transaction fee taking cash out?
I believe so. Yeah, I believe so. But again, there's always talk about how ATMs are probably going to be obsolete, but it's just not that the numbers just don't support it at this point.
Got it. When you all are have found a property that meets all of your criteria, what process do you initiate when you have found it, it underwrites, and you've got an LOI accepted?
You're not talking about the acquisition per se, or you're talking
Uh,
about
yeah, you found a property, LOI is accepted. Like what kind of due diligence do you all take for making sure that the property is what it looks like it should be?
well, so we have a whole team that does it, and yeah, a big part of it is going to be underwriting and making sure the assumptions. So we underwrite each of those deals ourselves, have multiple different scenarios, make sure the assumptions meet our criteria. Especially in the current market, debt is going to be a big part of where the risk is in any deal, and so traditionally we've stuck with fixed agency debt. I mean, and we are considering some options right now, just given where we are in the economic cycle. We are considering bridge debt for some of the newer deals we're looking at, just knowing that we're going to be possibly in an environment where rates are going to start dropping. But typically, the debt is big, and then and this is true for anyone who's looking to due diligence on a deal they're getting into, right? So sponsors and limited partners in general. Right now, we're heavily focused, and this is where I think there's safety in the deal, on deals that are cash flow heavy day one. So we like to see deals where day one, based on T12, income and year one pro forma expenses, I want to see upwards of 3% in cash flow. So anywhere from 3 to 5% is what we're looking at. And that's kind of hard to come by in this environment with interest rates being high. But if you have a deal that looks like that, I think we have a buffer over there. And so cash flow heavy, taking a look at the debt. And we've also, less so now, but in the last 12 months, we've tried to look at loan assumptions. That's something that, again, I feel like de-risks the deal when you're going in with a lower interest rate, and then really getting deals at the right basis. There are a lot of off-market deals now that we're able to negotiate really good discounts. So if you're able to get something at a very good basis, it's a great time to purchase those assets. Just the cyclical nature of real estate, we will be seeing cap rate compression in the next few years. So that itself is going to give us that boost. And then if we have a strong value add plan in there, you're really, again, deep diving into rent comps. As far as assumptions, we like to do 0%, especially for modeling out worst case scenario, 0% rent growth assumptions for year one at least, and then very slow rent growth going forward. Like you said, it's going to be a while before we're going to see big boosts in rents or even normalizing towards 3%, right? So very conservative assumptions. We underwrite it. And then I think another big part is actually working with operators who have a strong track record in that sub market. So if they have, we like working with sponsors who are vertically integrated, but they have construction management and property management in-house. So one part of it is underwriting it conservatively and acquiring the right properties. The biggest challenge is going to be in managing these properties well and operating them efficiently. And so we like working with sponsors who have those teams in-house if possible. If not, they should have had a long track record with those, property managers and construction teams in that market. So I think that's huge. So basically buying right, ensuring we have the ability to hold, that's where the debt part comes in, that's where the assumptions come in, and then going in and controlling the things that we have control over, which is operational efficiencies, catching up on loss to lease, and executing the business, the value add plan effectively, so that those are things that are completely in our control. Like we said, it doesn't depend on cap rate compression or market price appreciation, right? So
Yeah. I totally agree with you with the operator being vertically integrated. I think that's a requirement. If they're not, then they're going to get smoked at some point. You've got to
they
control the
will.
process through and
Yeah.
throughout. Renovation teams, the operations, the property management. What we have found is property management just throwing money at issues instead of fixing the issues. So it's once you can control everything holistically, the property performs, the returns go where they should be, and you're in total control, and you can operate the way it should be versus third party controlling the performance.
Absolutely. So that's one place where we've seen a lot of sponsors struggle in the last few years. Another place is access to capital. So we've seen a lot of sponsors go through capital calls and actually losing the property and losing all investor equity. That what's differentiated, the sponsors who've been able to protect their investors from that has been access to capital. So really having large cash buffers and working with when you are vertically integrated, I believe that you have more control and more access to capital also. So all of those things are going to have a huge impact in terms of how your sponsor does within the next few years.
Yeah, if you've got an operator who also manages the renovations and the property itself, they're a lot more selective on properties that are actually going all the way through to the purchase, because they know that after the purchase is where
Yeah.
where the real work begins.
Exactly.
And you're not just going to do these performance based on what if scenarios. It's got to be the most on point. If not, there's no point in even buying it, because you're just creating a living hell for yourself in a sense. So
it's true. There's definitely more accountability when there's vertical integration.
Yeah, 100%. Tell us about some learning lessons that you've had along the way.
I've had learning lessons along two lines, right? So the coaching part, where we're helping people build their own portfolios, I think the biggest thing that I've realized is that all of us are, I don't think you can fit all of us into the same box, right? So all of our goals are different, our aptitudes are different. And so I think people have to be very intentional about where they want to be in terms of real estate, right? There's a risk return spectrum and there's an effort return spectrum. And I say, even as you're starting out, decide where you want to be. What I've realized is that if people pick a strategy that doesn't make sense for them, so there are those who want to be super passive, they're just the investors. I think they do really well with syndications or buying long-term rentals and having a property manager manage it. And I feel like there are those who are who I call the entrepreneurs. They will do well in the short-term rental space. They will do well as general partners because it has to be run as a business. There will be ups and downs. And if you have the aptitude for that and you thrive in that environment, you do really well. And I feel like there's a bucket, which is what I did, like the short-term hustler, someone who goes in, does rehabs or does midterm rentals, bumps up your cash flow, and then a few years later you've hit your goals, you're able to transition that portfolio from active to passive, right? And I just say, anyone thinking about real estate, be very intentional, know there are different strategies, and there's a spectrum, and see where you want to be on the spectrum. That can change over time. When I've seen people pick the wrong strategy, I see them struggle and falter, and then they just stop, and that's not the right thing to do. So on one of this end of the spectrum, as a coach helping people build their own portfolios, that's a mistake that I see happen over and over again. Someone who is not going to thrive in the short-term rental space, trying to do it and then getting frustrated by the whole experience and then giving up. So be very intentional about where you want to be. As far as working as a sponsor, again, I think this is something we touched upon already, but access to capital, I think, is huge in terms of really working in those worst case scenarios where end of the day, with real estate, in the long term, every property will do well, right? Over time, a good deal becomes great and a bad deal becomes good. It's the ability to hold on to a deal and get it past that part. And so we keep huge reserves. I think the learning curve for me over the last few years has been just realizing that we just have to stress test more diligently and have huge cash reserve, because end of the day, that's what's going to get us to the other side and be able to preserve investor capital.
Maybe the investors can even ask for the sponsor's balance sheet. Just show us what you have. Make sure that you do have access to capital. And if you don't, then why are you the lead sponsor? Get with a GP team that has the experience, has the wherewithal, that can weather the storm, the experience. And you don't have to invest with someone that's new out of the gates that doesn't have experience. I think that's what makes it risky. And that's what you see out there in the marketplace is people that have never owned a business, and now all of a sudden they're buying a multi-million-dollar business and they're taking other people's cash to buy it. And then it ultimately ends up unfortunate in some instances. I think that we're going to see some things on a rocky road here on the last half of this year just because of that.
Absolutely. And we've already begun to see it, right? And I think for anyone listening, the easiest way to really analyze how a sponsor is doing is ask them about the deals that they acquired in the second half of 2021 and the first half of 2022, because that's where we're going to see the most distress, because people weren't underwriting for those rate increases and, they probably didn't have the right debt terms on. So ask them how they're doing with those properties. Ask them what distributions are looking like. Did they pause distributions? Did they have a capital call? What is their plan to rescue those deals? That's I think the single most important question for anyone trying to evaluate a sponsor right now, especially people who've been in business since 2018, 2019. Everyone did well when the market was trending upwards, but I think all the distress that we expect to see is going to be in deals acquired in that 1 year period. And for anyone trying to vet a sponsor, just ask them how those deals are doing, what they're doing with distributions, what their business plan is.
Yeah, for sure. And a lot of investors don't realize that the GP team is the last ones that get paid, truly last ones that get paid. And a lot of people on a GP team they're not getting paid. Investors might be getting their preferred return, but that doesn't mean that the GP team's getting paid. And I think that's you're going to see a little bit of a shift in the whole syndication marketplace as well. What was hot here last 4 years, being a syndicator, this and that, putting all of your efforts into the team, and they're putting it into the property management that's running it. I think there's going to be a lot of burn off in the industry, which it just comes with it.
Absolutely. And you're absolutely right. In a lot of these deals, the GPs will likely be the ones who will be getting nothing in return. But it's also important to look at what I've noticed in the space is that every general partner looks at it differently, right? So we have people who are huge in the space who are talking on multiple platforms on a regular basis, who are walking away from deals and losing investor capital. And then I've also seen general partners who are, putting in their own personal capital as member loans and doing everything they can to prevent a capital call situation for their investors. And so I think it's honestly a great time for anyone evaluating a sponsor, because instead of having to look at people getting 3x returns just because we were in a market where there was cap rate compression happening and everyone was doing well, you actually have the ability to really evaluate what a sponsor's values are and how far they will go to protect your capital as an investor. And so honestly, I feel like it's a better place to be for multiple reasons, right? We now have a track record for our sponsors, which is actually dependent on their ability to execute operationally. But we're also, and Josh, you know this, this is actually the market cycle. Again, and the market does go up and down. We're real estate market cycles. And so we were in expansion and hypersupply before. Everyone did well. Market sentiment was great. But now we are in recession. We're going into recovery. And so honestly, for investors, this is the best time. We have tons of opportunity to buy and actually, make generational wealth. But it's also the time with the most fear and the most anger, the most disappointment, especially if you've been in deals where you've lost capital as an investor. But I think again, as investors, we don't want to speculate. We're not going to run on emotions. And so it's a great time for people to really look at the fundamentals, realize that you have tons of opportunity in this market, vet your sponsors because you now have a track record that you can vet them on. And like I said, if you ask them about their deals in 21 and 2022 that were acquired in 2021 and 2022 and how they're managing it, you really know what their values are as a sponsor and how they can execute that business plan. But realize as an investor that this is a time of tremendous opportunity. And instead of listening to clickbait, look at the fundamentals and go in and make those acquisitions that are really going to give you outsized returns.
Yeah, right now real estate's on discount for sure. You can cash in at 25, 30% off coupon.
Exactly.
And whatever you buy right now, it will absolutely hit the glass ceiling that was just created 2 years ago. And it's going to exceed that tremendously. There's the supply is going to continue constrained. It's just buying right, financing right, and managing it right, and it'll be a great asset for years to come. We're very heavily underwriting and purchasing right now. It's a great time to do so.
Yeah, and I think this is for anyone listening who wants to be a passive investor. This is a great time to really be intentional about your buy box. Like I said, that you don't want to go and buy everything that's being presented to you. Be very clear about your buy box. What's important to you, what hold period makes sense for you, what cash flow are you looking at, what's more important for you, cash flow today or growth in the long term. Be intentional about that. What class of assets make sense for you? Where do you want to be in that risk return spectrum? Are you looking at high risk, high return deals like ground up developments, or is it more stabilized value add that makes sense for you? So be very intentional about that, and then do your vetting for both the sponsor, the market, and the deal. And we have a free due diligence checklist that it's a quick read, but it kind of covers, summarizes all of this. Right? How do you build your buy box as an investor? How do you vet a sponsor, market, and deal? And how do you come up with a quick due diligence checklist that you can use every time you're looking at a deal? It's generationalwealthmd.com/guide in lowercase, and I highly recommend people take a look at that and use it to do your own due diligence and not just expect the sponsor to be doing everything correctly.
Yep, for sure. That's great. Param, if somebody wants to reach out to you, learn more about yourself, possibly invest alongside with you, how can they get a hold of you?
So the best way is our website. It's gwcapital.com, capital with an A. And then, like I said, we have GenerationalWealthMD.com is our is our other website where if you want to look at those numbers that I was talking about, how do you get 200% returns in 6 months? I have a free ebook, tons of resources over there, free calculators if you're trying to underwrite yourself for a single family home or a short-term rental. So tons of resources over there. But both of those sites, GenerationalWealthMD.com and gwcapital.com would be the best ways to get in touch with us.
Perfect. Awesome. Well, we definitely appreciate the insights. I look forward to following you, and we'll certainly talk soon.
Absolutely. Thank you, Josh.
Thank you.